Welcome to the Investor Bunny Show, your go-to podcast for smart investing and financial freedom. Let's dive in. All right, so you've been digging deep into some really interesting stuff lately, huh? You've been sending over articles and notes all about this thing called intrinsic value.
Yeah, definitely. I think it's a really important concept to grasp, especially if you're, someone who wants to make informed investment decisions.
Absolutely. And, the stuff you shared with me was really interesting. You sent me this article, Intrinsic Value of a Stock, what it is and how to calculate it.
Yeah.
I think that was the title.
That's the one.
Yeah, and then another one that I thought was great was intrinsic value versus current market value. What's the difference? And then on top of that, you even sent over some of your own study notes on the whole topic of intrinsic value.
Gotta keep track of all my thoughts, right?
For sure. Well, I have to say, I really appreciate all those resources you sent over. It definitely gave me a good foundation for our deep dive today. And I think our mission today, if we can kind of sum it up, is to really unpack this whole concept of intrinsic value. Like, what does it actually mean?
Yeah.
Why is it so important for investors? And, how do we actually go about calculating it?
Yeah, because there's a lot of, noise in the market, everyday prices going up and down, news headlines.
Oh, yeah, absolutely.
And it's hard to see through all of that sometimes.
Totally. And I think, a really important thread that runs through all this is figuring out the difference between a company's intrinsic value and its market value.
Yeah, that's a huge one. Probably the most fundamental distinction that an investor has to wrap their head around.
For sure. So let's just jump right in with the basics here. When we talk about intrinsic value, what exactly are we talking about?
So intrinsic value, you can think of it as the true underlying worth of a company or a stock.
Okay.
And the key here is that it's based on the company's fundamentals.
Okay.
It's not just about the price that it's trading at right now.
Gotcha. So it's not just looking at the ticker and seeing, oh, it's at, $20 a share.
Exactly. It's like looking under the hood, trying to figure out what's really driving the business, how much cash it can generate, how profitable it is, how much it can grow in the future.
So it's almost like trying to get a sense of its real economic value.
Yeah.
As opposed to just, the whims of the market at any given moment.
Yeah, you got it. And this is a concept that's been championed by some of the most successful investors of all time, guys like Warren Buffett, Benjamin Graham.
Yeah, those are some big names.
Right. These are the titans of value investing, and they always emphasize the importance of understanding intrinsic value.
Okay, so they're really saying that a company's worth is not always accurately reflected in its stock price.
Exactly. They believe that the market can be irrational at times, driven by emotions, greed, fear, speculation. So for them, the key is to find those situations where the market is undervaluing a company, where the stock price is significantly lower than their estimate of its intrinsic value.
So essentially, they're looking for bargains in the market, trying to buy a dollar for 50 cents.
Right, and then hold on to those investments for the long haul.
So their whole strategy revolves around this gap between intrinsic value and market value.
Exactly. And that brings us to, another important point, which is that there are different ways to look at investing. We have value investors like Buffett and Graham, but you also have technical analysts, momentum investors, and then you have the proponents of the efficient market hypothesis.
Yeah, there are definitely a lot of different schools of thought out there when it comes to investing.
Right. So technical analysts, for example, they focus on price charts and trading patterns.
Oh.
They believe that all the information about a company is already reflected in its stock price. So they're trying to predict future price movements based on past trends.
Okay, so they're not as focused on the fundamentals of the business.
Not as much. No, they're more interested in the technical signals.
Okay.
Then you have momentum investors. They're kind of the opposite of value investors. They're jumping on the bandwagon, buying stocks that are already going up.
So they're riding the wave, hoping to profit from the momentum.
Exactly. And then you have the efficient market hypothesis, which in its strong form states that it's basically impossible to beat the market.
Okay, so this theory is saying that all available information is already factored into stock prices.
Right. So according to this theory, trying to find undervalued stocks is like trying to find a needle in a haystack.
So essentially they're saying the market is always right.
In a way, yes, they're saying that it's very difficult, if not impossible, to consistently outperform the market by picking individual stocks.
But value investors like Buffett and Graham, they would disagree with that, wouldn't they?
Yeah, they would argue that the market isn't always efficient, that there are times when emotions and biases create mispricings.
Okay, so for them, it's all about taking advantage of those inefficiencies in the market.
Exactly. They believe that by doing their homework and understanding the true value of a business, they can find opportunities that the market has overlooked.
So it seems like this whole idea of calculating intrinsic value, it's really about making informed and rational investment decisions.
That's a big part of it, yes. It's about cutting through the noise and focusing on the long-term fundamentals.
And not getting caught up in all the short-term fluctuations and hype.
Exactly, because those things can really lead you astray.
So it's really about discipline and patience.
It is. It's about having a long-term perspective and not letting emotions dictate your investment choices.
So we've talked a lot about intrinsic value now. Let's shift gears a little bit and talk about market value.
Okay, sounds good.
Because I think it's really important to understand the difference between the two.
It is, and it can be a little confusing at times.
Sure.
So market value is simply the current price of a company's stock in the market.
Okay, so it's what you see when you look up a stock ticker.
Exactly. It's the price that buyers and sellers are agreeing on at any given moment.
And as we all know, those prices can move around quite a bit.
Oh, yeah. They can be very volatile, influenced by all sorts of factors, news events, rumors, economic data, investor sentiment.
Yeah. The market can be a bit of a roller coaster sometimes.
Definitely. And that's one of the key differences between intrinsic value and market value.
Okay.
Intrinsic value is based on the fundamentals of the business, whereas market value can be influenced by a lot of external factors that may not have anything to do with the company's long-term prospects.
So it's like intrinsic value is the true north and market value is the compass that's constantly being pulled in different directions.
That's a great analogy, yeah. Intrinsic value is trying to determine what the company is really worth based on its underlying business, whereas market value is simply a reflection of what the market thinks it's worth at any given moment.
And the market can be wrong, can it?
Oh, absolutely, all the time.
And you give us a quick example just to illustrate this difference?
Sure. Imagine you have two companies, Company A and Company B.
Okay.
Company A is a solid business with a strong track record of profitability and growth.
Okay, sounds good.
You do your analysis and you estimate its intrinsic value to be around $50 per share. But due to some negative news or maybe just overall market pessimism, the stock is currently trading at $25.
Oh, wow. So there's a big gap there.
There is. And that's where a value investor would see an opportunity because they believe the market is undervaluing the company.
Okay, so they would see that as a chance to buy low.
Exactly. Now let's look at Company B. This company might be in a hot sector, or maybe it's got a lot of hype surrounding it. The market is very optimistic about its prospects, and its stock price has soared to $50 per share. But when you dig into the fundamentals, you realize that its intrinsic value is closer to $25.
So in this case, the market is being a bit too enthusiastic.
Yeah, it's getting ahead of itself.
Yeah.
The hype is driving the price up beyond what the company's fundamentals can justify.
So a value investor will probably steer clear of Company B in this scenario.
Most likely, yes. They would see it as overvalued, and they would wait for the price to come down closer to its intrinsic value.
That's a really helpful example. Thank you. And we've mostly been talking about publicly traded companies here.
Right.
Is it easier to determine both intrinsic value and market value for these types of companies?
Yes, it definitely is. And that's because public companies have to disclose a lot of information about their financials. They have to release their financial statements regularly, things like their income statement, balance sheet, cash flow statement.
So all that data is out there for anyone to see.
Exactly. And their stock prices are also publicly available, so it's much easier to get a handle on both their intrinsic value and their market value.
That makes sense. So why should investors even bother trying to calculate intrinsic value? I mean, it seems like a lot of work.
It is work, but it's worth it because understanding intrinsic value helps you make better investment decisions.
Okay.
It allows you to compare a company's market price to its true worth and identify potential opportunities.
So you can spot those situations where the market is either overreacting or underreacting.
Exactly. And this leads us to another important concept that you brought up earlier, the margin of safety.
Ah, yes. This is something that Benjamin Graham was a big advocate for.
He was, and it's a really crucial principle for value investors. The idea is that you shouldn't buy a stock just because its market price is slightly lower than your estimate of its intrinsic value.
Okay.
You should aim to buy it at a substantial discount.
So you're building in a buffer just in case you're wrong about your valuation.
Exactly. You're giving yourself some room for error because no one can predict the future with perfect accuracy.
And this margin of safety, how much of a discount are we talking about here?
Well, it depends on the specific situation, but Graham recommended a margin of safety of at least 25%.
Okay, so if you think a company's worth $50 a share, You wouldn't buy it unless it was trading at 37.50 or lower.
Right. And sometimes the margin of safety might need to be even higher depending on the uncertainty surrounding the business or the industry.
So what are the main benefits of using this margin of safety approach?
Well, firstly, it protects you from downside risk. If you buy a stock at a significant discount, even if your intrinsic value estimate turns out to be a bit optimistic, you're less likely to lose money.
That makes sense.
Secondly, it enhances your potential for upside if your valuation is correct. Buying at a lower price means you'll make a bigger profit when the stock price eventually rises to reflect its true worth.
So it's kind of a win-win situation.
In a way, yes, it reduces your risk and increases your potential reward.
And I imagine it also helps investors stay disciplined and avoid making impulsive decisions.
Definitely, it forces you to be patient and wait for the right opportunities instead of chasing after every hot stock that comes along.
So this whole philosophy of intrinsic value and margin of safety, it's really about taking a rational and long-term approach to investing.
That's the essence of it.
So now let's get into the nitty-gritty of how we actually calculate intrinsic value.
Okay.
Because I know there are different models and methods out there, and they can get a little complex.
They can, but the good news is that the underlying principles are fairly straightforward.
That's good to hear. So what are the main approaches that investors use?
Well, the resources you shared mentioned 3 primary methods. And, as your source said, it all starts with this idea that cash is king.
Cash is king.
That's right. At the end of the day, a company's value is determined by its ability to generate cash.
Okay.
So the 3 main models all try to capture this in different ways.
All right, let's start with the first one, which is the dividend discount model, or DDM.
Okay, so the DDM is a method for valuing companies that pay dividends to their shareholders.
Okay, that makes sense.
The basic idea is that the value of a stock is equal to the present value of all the future dividends that the company is expected to pay out.
So you're basically discounting those future cash flows back to their present-day value.
Exactly. And there's a basic formula for this. You take the expected dividend per share in the next period and divide it by the difference between the required rate of return on equity and the expected dividend growth rate.
Okay, that sounds a little complicated, but I think I get the general idea.
Yeah, it's basically saying that the value of a stock is determined by how much cash it's going to pay you in the future and how much that cash is worth today.
And the notes also mention a specific variation of this model, the Gordon Growth model.
Yes, the Gordon Growth Model, or GGM, is a simplified version of the DDM.
Okay.
It assumes that a company's dividends will grow at a constant rate forever.
Forever, that's a big assumption.
It is, but it can be a reasonable assumption for stable, mature companies with a long history of steady dividend payments.
Okay, so companies that are kind of like the blue chips of the market.
Yeah, exactly. Right. Companies that are well established and have a predictable future.
And the formula for the GGM looks a bit different, doesn't it?
It does. The formula is P equals D1 divided by R minus G.
Okay, so let's break that down. What do all those letters represent?
So P is the present value of the stock. D1 is the expected dividend per share 1 year from now.
Okay.
R is the required rate of return, which is basically the minimum return that investors expect to earn on their investment in the stock. And G is the constant annual growth rate of dividends.
So this model is really geared towards those steady Eddie companies that pay out consistent dividends year after year.
Yeah, and it's particularly useful for valuing companies in regulated industries like utilities or companies whose growth is expected to be in line with the overall economy.
Okay, so it's not going to work as well for those high-growth tech companies that are constantly reinvesting their profits.
Right. For those types of companies, you need a different valuation method.
And that brings us to the second method you mentioned, which is the discounted cash flow analysis, or DCF.
Yes, the DCF is a more versatile valuation method that can be used for a wider range of companies.
Okay.
It's based on the idea that the value of a company is equal to the present value of all its future free cash flows.
Free cash flow. That's a term we hear a lot in finance.
It is, and it's a really important concept. Free cash flow is the cash that a company has left over after paying for its operating expenses and capital expenditures.
So it's the cash that's available to be distributed to investors or reinvested back into the business.
Exactly, and the DCF method tries to project those future free cash flows and then discount them back to their present value.
And the formula for this is a bit more involved than the DDM.
It is. The formula is DCF equals the summation from T equals 1 to N of FCF sub T divided by 1 plus R raised to the power of T plus TV divided by 1 plus R raised to the power of N.
Oh, wow, that's a mouthful.
It is, but it's not as scary as it looks.
Okay.
Basically what it's saying is that You need to forecast the company's free cash flows for a certain number of years, typically 5 to 10 years.
Okay.
And then you need to estimate the terminal value, which is the value of the company beyond that forecast period.
So you're trying to capture the long-term value of the business.
Exactly. And then you discount all those future cash flows back to their present value using a discount rate, which is usually the company's weighted average cost of capital, or WACC.
And WACC, that takes into account the cost of both debt and equity financing, right?
That's right. It's a blended rate that reflects the overall cost of capital for the company.
Okay, so the DCF method sounds pretty comprehensive.
It is, and that's why it's so popular among analysts. It captures a lot of the key factors that drive a company's value.
So what are the main advantages of using the DCF?
Well, firstly, it can be used for a wide range of companies, regardless of whether they pay dividends or not.
Okay, so it's more flexible than the DDM.
Exactly. Secondly, it focuses on free cash flow, which is a more accurate measure of a company's profitability than accounting earnings.
Because accounting earnings can sometimes be manipulated.
They can. And thirdly, it takes into account both the company's current operations and its future growth potential.
So it's a forward-looking approach.
It is. And finally, it incorporates the time value of money, which is the idea that money received today is worth more than money received in the future.
That's an important concept.
It is, because it reflects the opportunity cost of investing your money.
Okay, so we've covered the DDM and the DCF. Now, what about the third method? You mentioned the residual income model.
So the residual income model is a bit different from the other two methods. It's not as widely used, but it can be useful in certain situations. The basic idea is that a company's value is equal to its book value plus the present value of its future residual income.
Residual income, what exactly is that?
Residual income is the income that a company generates in excess of its required rate of return on equity.
Okay, so it's the profit that's left over after the company has paid its investors their expected return.
Exactly. And the residual income model tries to capture the value of that excess profit.
So this model is really focused on the company's ability to generate returns that exceed its cost of capital.
That's right. It's looking at how much value the company is creating for its shareholders.
And this model is particularly useful for companies that don't pay dividends or have unpredictable cash flows.
Yeah, in those cases, the DDM and the DCF might not be as reliable.
So we now have 3 different methods for calculating intrinsic value. But I imagine it's not always easy to come up with a precise number.
No, it's not. It's more of an art than a science.
And what are some of the factors that can make it difficult to accurately estimate intrinsic value?
Well, firstly, all these models rely on assumptions about the future.
Okay.
You have to make assumptions about things like revenue growth, profit margins, interest rates, and so on.
And those assumptions can be wrong.
Absolutely no one has a crystal ball.
And what else?
Well, secondly, intrinsic value can change over time.
Okay.
A company's fundamentals can improve or deteriorate depending on a variety of factors.
Such as
Changes in management competition, new technologies, government regulations, all sorts of things.
So intrinsic value is not a static number. It's constantly evolving.
That's right. And thirdly, these models don't always capture the intangible aspects of a business.
Okay. Like what?
Like brand reputation, customer loyalty management, quality, things like that.
So those qualitative factors can be hard to quantify.
They can, but they can definitely have a big impact on a company's value.
So it seems like these valuation models are useful tools, but they shouldn't be used in isolation.
Exactly. It's important to use multiple methods and to cross-check your results.
And it's also important to be conservative in your assumptions.
Yes, definitely. It's better to err on the side of caution and build in a margin of safety.
And one last thing I wanted to ask about is this concept of economic moats.
Ah, yes. Moats are essential for long-term success.
So what exactly are economic moats?
Economic moats are sustainable competitive advantages that allow a company to protect its profits and market share from competitors.
So it's like a barrier that makes it difficult for other companies to enter the market.
Exactly. And there are different types of moats.
Such as?
Well, a strong brand can be a moat. Think of companies like Apple or Coca-Cola.
Okay.
A large network of users can also be a moat. Think of companies like Facebook or Google.
Right.
High switching costs can be a moat. Think of software companies that lock in their customers with complex systems.
So these moats are really about creating barriers to entry.
That's a big part of it, yes. And when you're valuing a company, it's important to consider the strength and durability of its moat.
Because a company with a wide moat is going to be able to generate higher profits for a longer period of time.
Exactly, and that will be reflected in its intrinsic value.
So when analysts are building their valuation models, they might adjust their assumptions to account for the presence of a moat.
Yes. For example, they might use a lower discount rate, or they might project higher growth rates for a company with a strong moat.
Because those companies are less risky and they have more potential for future growth.
That's right.
Well, this has been a fascinating deep dive into the world of intrinsic value.
It has been.
We've covered a lot of ground, and I think we've gained a much deeper understanding of this important concept.
Well, I hope so.
So to sum it all up, it seems like calculating intrinsic value is not an exact science, but it's an incredibly valuable exercise for any investor who wants to make informed decisions.
Absolutely.
It forces you to think critically about a company's fundamentals and to look beyond the short-term fluctuations of the market.
And it helps you identify those rare opportunities where the market is mispricing a stock, either to the upside or the downside.
Exactly. And it all comes down to this crucial distinction between intrinsic value and market value.
That's the key takeaway.
The market can be driven by emotions and speculation, but intrinsic value is grounded in the cold, hard facts of a company's financial performance.
And by understanding that distinction, you can make much better investment decisions.
So as you, our listener, go out and consider your next investment, I want you to think about how this concept of intrinsic value might change your approach.
That's a great challenge.
Yeah, think about what assumptions you would scrutinize most closely in your own valuation calculations.
And how you might use this knowledge to find those hidden gems in the market.
Thank you for joining us for this deep dive into intrinsic value.
It's been a pleasure.
We'll see you next time.
See you then.
Thanks for tuning into the Investor Bunny Show. Subscribe, share, and keep investing wisely. We'll see you next time.